Hello everyone, a very good evening. Welcome to the marathon class of your module A for the BRBL paper of CAIIB June 2025 cycle. Very quickly join the session, share it with others so that they can also join and we can start. Today we'll be discussing all the possible MCQs, case studies, statement type questions from our module A. In yesterday's session, we have completed the theoretical part of module A of our syllabus, and today we'll be practicing questions. So once you are here, just mark your attendance so that I can know who all have joined. We'll wait for 2 more minutes and then we will start. Before we start, if you have any doubts, any queries from the module A that we have studied yesterday, you can ask. And this is a marathon, so we will try to cover as many questions as possible quickly. I've also included the explanation of some topics that are important for your revision. You'll also get the PDF of it after the class so that you can download and revise. All right, so I think we are good to go and we can start. So here's the first question from our module A, the first question of this marathon. Which of the following is not a necessary element under the definition of banking in section 5B of the Banking Regulation Act? Recall the definition. This is the most basic, and we are starting with a simple question. So, which of the following is not a necessary element? Accepting deposits from for the purpose of lending, accepting deposits from the public, acceptance of gold ornaments as security, withdrawability by check, draft, or otherwise. So, the module A, which basically covers our Banking Regulation Act and the Reserve Bank of India Act, foremost, the section 5B, which defines banking, the business of banking. So, according to the definition, which of the following is not necessarily included as essential functions of a bank? So, the section 5B defines banking, yes, as the accepting for the purpose of lending or investing deposits of money from the public, and they are repayable on demand. So, acceptance of deposits, and these deposits are accepted from the public. These deposits are withdrawable on demand. So the correct answer here should be option C. Acceptance of gold ornaments as security. This is one of the functions that banks might perform, but the definition of banking includes only two parts: accepting of deposits that are withdrawable on demand and using those deposits to give out loans, right? So the correct answer will be C. And I've also included the definition. A bank necessarily performs two essential functions: acceptance of deposits, lending or investment. These deposits are repayable on demand, and deposits of money only from the public, not any valuable item. All right, so this is the definition. So the correct answer is C. Yes. All right, next question. Identify which of the following statements are correct. Banks must accept deposits only in the form of money and not valuables. Deposits accepted by the banks must always be repayable on demand. The KYC norms enable the government to open zero balance accounts. And under certain conditions, individuals may be prohibited from using bank in their firm's name. So, which of the following statements are correct? 1, 2, and 3, 2, 3, and 4, 2 and 3, or 1 and 4? Those who have joined on the YouTube platform, you also try to answer the questions. So the first statement says banks must accept deposits only in the form of money. This is correct. Any tangible goods, those are not accepted. Deposits accepted by the banks must always be repayable on demand. No. Demand deposits are accepted by banks and term or fixed deposits as well. So these are not always repayable on demand. So second statement becomes incorrect. KYC norms enable the government to open zero balance accounts. This is also incorrect. The KYC norms might make it feasible to give out the direct benefit transfers, to give out or distribute the subsidies, or decide the sector of the economy that might need financial inclusion, but to open zero balance account, that is not a purpose. So 3 becomes incorrect, and under conditions, individuals may be prohibited. So any entity other than that who has been given a license by RBI, they cannot use the term bank, banker, or banking in their firm's name. So statement 4 also becomes correct. Yes, so the correct answer will be 1 and 4. D, option D is correct. Also, it is not necessary that anyone who offers money for the deposit, bank is going to accept them. No, bank will reject to open accounts of the undesirable persons, and these opening of accounts is subject to the fulfillment of certain conditions like KYC, anti-money laundering. All right, so the correct answer will be D, 1 and 4. All right, next question. Consider the following statements and identify the correct ones. NBFCs can freely accept demand deposits without RBI regulation. Only a licensed entity under Section 22 can conduct the banking operations. Deposits that are withdrawable by check can be accepted by anyone with a current account. Certain cooperative societies are exempted from the naming restrictions of Section 7. Read the statements very carefully and then select the correct ones. So which statements are correct? 1, 2 and 3, 2 and 4, 2 and 3 or 1 and 4. So statement 1 is straight away incorrect because NBFCs are not allowed to accept demand deposit. If a specific scheme is created by the government, then it becomes an exception. Statement 2 is correct. Only after getting a license under Section 22, the bank can conduct or a firm can conduct the banking operations. Then deposits, no, deposits cannot be accepted by anyone. Demand deposits, there's a restriction. So they cannot be accepted by anyone with a current account. This is incorrect. And statement 4 is correct because certain cooperative societies are exempted from the naming restriction. All right. What are these cooperative societies? We also have subsidiaries of banks, associations of banks. We also have the primary credit societies, which is a cooperative society, let's say, formed for the purpose of protection of the mutual interest of the cooperative banks. They are exempted from this restriction of using the term bank, banker, or banking in their name. So the correct answer will become B, 2 and 4. We were asked the correct statements. So 2 and 4. All right. So the acceptance of deposits by the NBFCs is regulated by RBI under the non-banking financial companies acceptance of public deposits directions. License for banking, as we have already seen, under Section 22. First, the entity will have to apply for the license. RBI will conduct its scrutiny, the fit and proper criteria, and then the license will be allotted. Only after that they can commence with the banking operations. Yes, correct. B. All right. As per Section 8 of the Act, which of the following instruments are not considered goods for the purpose of trading prohibition? So, we had studied about two sections. We had studied about the permitted business, which are given under Section 6(1) of the Banking Regulation Act, and the prohibited business, which is given in the Section 8. So permitted business apart from acceptance of deposits, lending and investing. It also includes dealing in bills of exchange, including drawing, accepting, buying, selling, lending or advances with or without security, any kind of guarantee and indemnity business. These are permitted. Prohibited business are buying or selling or bartering of goods directly or indirectly. How do we define the goods? So, which of the following is not considered goods? Furniture and bullion, actionable claims and shares, agricultural produce and bullion, specie and chattel. Answer this question. So, when we are talking about goods for this particular section, it means every kind of movable property other than actionable claims, stocks, money, bullion, shares, specie. So, the correct answer will become yes, the correct answer will be B. Actionable claims and shares. These are the exception. So if a bank is trading in actionable claims and shares, that is not prohibited. Other than that, all the kind of movable property will be included in the definition of goods. And the banks are not allowed to deal in them. These are the prohibited business. All right? Okay, next. Let's say a banking company receives a house as a part satisfaction of a defaulted loan. It must dispose of the property within. This is another clause that the banks are not allowed to hold immovable property. This is also there that no banking company shall hold any immovable property except which is obviously required for its own use. So if let's say it is acquired, then within what time period should it be disposed of? Within 7 years from the acquisition, 5 years from the acquisition, 10 years from the loan default, or 3 years from the commencement of winding up. Try to answer this question. What is the time period within which it should be disposed of? Right. So, although a bank is not allowed to hold any immovable property, still, if it comes to the bank's holding as a part satisfaction of a defaulted loan, it must be disposed of within a period of 7 years from the acquisition. And this 7 years further can be extended by a period not exceeding 5 years. Wherever RBI is satisfied that such extension would be in the interest of the depositors of the banking company. Already. So here what do we get to see? No banking company shall hold any immovable property in any manner for any period exceeding 7 years. All right. Hmm. Also, within this period of 7 years, the banking company will not deal in such property. I mean, they will try to facilitate the disposal within the 7 years period. So the correct answer becomes A. Remember this point. 7 years extended to 5 years more. Next, which of the following activities does not amount to prohibited trading in goods as per Section 8? Again, the Section 8 is quite important. So, selling motor vehicles to recover the bad debts, running a gold loan scheme, buying agricultural produce for resale, operating a retail outlet for electronic goods. So again, the prohibition says that the banks they cannot directly or indirectly engage in the buying and selling of movable property. But which of these does not amount to prohibited trading in goods? Can the bank sell motor vehicles to recover their bad debts? Will it be permitted? Yes, because it correctly says to recover the bad debts, right? The Section 8 prohibition says that only if, let's say, they are selling the property to recover their dues, that is allowed. And the option correctly says that they're selling the motor vehicle to recover their bad dues, the bad debts, the NPAs. So that is allowed, it is not prohibited. So the correct answer will be A, selling motor vehicles to recover the bad debts. All right. Again, we have a multiple selection question. Take your time, read the statements carefully, and then answer. Identify which of the following statements are correct. Section 8 prohibits the banks from engaging in trade but permits realization of the secured assets. Section 6, subsection 1, banks can engage in guarantee and indemnity business. Immovable property acquired by a bank can be held perpetually with RBI permission. Perpetually means on a continuing basis. And goods include shares and bullion for the purpose of Section 8. I think you can easily answer this question now. Yes, what will be the correct answer? Which of the following statements are correct? Right, so here the statements that are correct are 1 and 2 only, right? Because the immovable property, if acquired by the bank, will have to be disposed of within the 7 year period, as we have discussed in the previous question. Also, the goods definition for the prohibited business, that is trading, buying, and selling of goods, it does not include shares and bullion. So the correct answer becomes A, 1 and 2 only. 1 and 2 only. All right? Okay. Which of the following are true as per the provisions of Section 6 to Section 9 of the Banking Regulation Act? Trading in goods indirectly through subsidiaries is allowed for the banks under Section 8. Banks may administer estates in a fiduciary capacity under the permitted business. Banks may retain property acquired in satisfaction of loans beyond 7 years without RBI permission. Section 8 bars direct and indirect exposure to market trading risks. So now what will be the correct answer here? Which statements are correct? Is trading in goods indirectly through subsidiaries is allowed? No, the section 8 clearly says directly or indirectly trading in goods is not allowed. So A, the first statement becomes incorrect. Then banks may administer estates in a fiduciary capacity under the permitted business. This is true. Banks cannot retain the property even though it come to them in satisfaction of the loans. And statement 4, the section 8 bars direct and indirect exposure to the market trading risk. So statement 2 and statement 4 are correct. Right. So the section 8 clearly mentions directly or indirectly. So indirectly means through the subsidiaries or associations. That is also not allowed. All right. That is why this statement 1 will be incorrect. Okay. Which of the following are true as per the RBI Act and its amendments? The Central Board of Directors includes nominees of the central government only from the local boards. RBI can replace the board of an NBFC under the 2019 amendment. The RBI Act gives RBI the power to appoint chairman of every scheduled bank. The Section 19 of the Act defines businesses the RBI may not undertake. So now we are talking about the RBI Act. The RBI Act of 1934 was enacted by primarily to regulate the issue of banknotes, keeping reserves of the banks to ensure and secure the monetary stability. If you remember, we discussed about the general superintendents and directions of the affairs and business of RBI. They have been given to the Central Board of Directors. To the Central Board of Directors. What is the composition of this board? There will be a governor and not more than four deputy governors appointed by the central government. Four directors that are nominated by the central government, one from each of the local boards. 10 directors which are nominated by the central government, and other than that, two government officials also nominated by the central government. This is the composition of the board. But the statement 1 says that it will include only the nominees of the central government from the local boards. So statement 1 is incorrect. Then, can RBI replace the board of an NBFC? Yes. Now the NBFCs are under the control of RBI. With this amendment that was made in 2019, RBI has been given the powers. All right. So after this amendment, which took effect from August 9th, 2019, with respect to powers given to RBI for the regulation of NBFCs, the other changes, limit of net owned funds has also been enhanced. RBI has been provided with two ways to control the management of a regulated NBFCs. They can replace the directors, they can also supersede its board. RBI can remove or debar an auditor from exercising the duties as an auditor. All right, inspecting the books of accounts in public interest, framing schemes for amalgamation, restructuring, furnish statements, information. All of these powers have been given to RBI after this amendment. All right, so the correct answer becomes C, 2 and 4. 2 and 4. But it does not give RBI the power to appoint the chairman of every scheduled bank. That is not there. Okay, so here the details of this amendment have been given. The net own funds have been enhanced to rupees 100 crore. Existing it was 2 crores. Then the net own funds for the different categories of NBFCs have also been defined. These powers are there. All right. When we talk about the different sections, so section 19 is the business that the RBI cannot transact. Section 17 is the business that RBI may transact. The right to issue bank notes under section 22. The power of the central government to supersede the central board, section 30. All of these sections are there. All right. Okay. Consider the following statements and identify those that are true. RBI has statutory powers to issue directions in the interests of public goods under the Banking Regulation Act. Section 35 mandates every bank to submit a quarterly asset liability statement to Parliament. RBI supervises shareholding in banking companies to ensure the prudent governance, and the IBC empowers RBI to replace the board of a defaulting bank directly. Again, powers that have been given to RBI. So if you remember the Banking Regulation Amendment Act, which added of 2017, which added two new sections, 35AA and 35AB, which authorized RBI to issue bank notes to or issue directions to any banking company, initiate the insolvency resolution process in case of default, the supervisory program on assessment of risk and capital, the spark. All of these powers are there. So what will be the correct answer? Which statements are correct? Hmm. Statement 1 is true. RBI has statutory powers to issue directions in the interest of public good. This is section 35. Section 35, however, does not mandate every banking company to submit a quarterly asset liability management to the parliament. That is not there. Statement 3 is also correct for the prudent governance. But statement 4, that IBC empowers RBI to replace the board of a defaulting bank directly, that is also not true. All right, so these are the powers that have been given to RBI. So the correct answer will be 1 and 3. After the amendment of 2017, these two powers have been given. They can conduct the annual financial inspection. RBI can make a comprehensive risk assessment. Then setting up of the DEAF, the Depositor Education and Awareness Fund, for taking over the funds in the inoperative accounts. All right. So the correct answer will be B. Till here, I hope everything is clear. Yes. All right. Great. Okay. Next question. Here is a scenario based question for you. A private investment firm XYZ Capital starts accepting deposits from customers that are withdrawable by check. Which of the following statements is correct regarding the legality of this action under the Banking Regulation Act? The XYZ Capital can legally accept such deposits if it registers under the NBFC framework. The XYZ Capital cannot legally accept deposits withdrawable by check unless it is authorized by the central government. Any NBFC can automatically accept the deposits that are withdrawable by check. The restriction only applies to firms and does not apply to individuals. So, which of the following will be true? regarding this scenario. Like we said, even NBFCs, if they want to accept deposits that are withdrawable by check, there is a restriction on them because they cannot legally accept deposits unless it is authorized by the central government under some specific scheme. So the correct answer will be B. It is not legally correct. So the XYZ Capital, which is an NBFC, cannot legally accept deposits which are withdrawable by check unless it is authorized by the central government. All right. All the other statements will not be true. I hope this is clear. So even NBFCs, they can accept deposits, but these should not be withdrawable by check. Only under the special scheme it is allowed. Okay. What is not a component of the Central Board of Directors of RBI as per the Act? Again, this also we have already discussed. Two members from RBI Employee Union, four directors from the local boards, governor and up to four deputy governors, two officials nominated by the central government. Very quickly answer this question. Already we have discussed the composition of the central board. Yes, the central board of directors. Let us once again write it down. So yes, it will include a governor and up to four deputy governors, then four directors that are nominated by the central government, one from each of the local boards, then two officials, government officials, which are again nominated by the central government, but two members from the RBI employee union. This is not true. They will not form a part of the central board of directors. Other than these three, there are 10 directors which are nominated by the central government. All right. And I've included the notes as well. So here you can see the composition of the board. And this board has the power of general superintendence and direction of the affairs and business of the bank. All right. Okay. Now, which of the following matters can an aggrieved banking company appeal to the central government against? Central government has also been given certain powers. The government as the regulator of banks, if you remember, this was under section 7 subsection 1. The powers that were given where government can give instructions or directions to RBI regarding certain cases, but only in exceptional situations. So can you tell me when have these powers used by the central government? When has the central government utilized these powers that are given to them under the section 7 of the RBI Act? Yes, it has been used only once. One time when in October 2018. What was the purpose? Separate letters were sent to RBI governor and directions were given on issues ranging from liquidity for the NBFCs, capital requirement for the weak banks, lending to the SMEs. Right. So here the correct answer will be B. Cancellation of license under section 22. Right? Yes. So if RBI cancels the license of any banking company, they can make an appeal to the central government and the decision of the central government will be final. Other areas: appeal against the removal of a managerial personnel of a bank, Similarly, appeal against cancellation of banking license, refusal of certificate, suspension of operations, any other business that a banking company may engage. Right? So the correct answer is B. Great. Okay. Identify the correct statements. Section 7(1) empowers the Government of India to direct the RBI without any consultation during national security threats. Under Section 10(b) and 36(a), appeals against the managerial removal by RBI lie with the central government. Only the RBI has the power to inspect banks under all circumstances. The Government of India can exempt banks from the provisions of Banking Regulation Act under Section 53. Answer this question. Which statements are correct? Can Government of India direct RBI give any instructions without any consultation? Or the consultation with the governor is required? Statement 2 is correct. Appeal against the managerial removal of the managerial personnel. This we have already seen. This is true. What else? And does only RBI has the power to inspect banks? No. Even the government has power to inspect the banks. So the correct answer will be 2 and 4. Option C. 2 and 4. All right. So if we are talking about the inspection, the returns, inspection, winding up merger, right? Also submission of returns of the accounts and balance sheet, return of assets in India, unclaimed deposits, monthly returns. If we are talking about an inspection, so inspection can be conducted by RBI. It conducts the annual financial inspection. If we are talking about the government, if the inspection is carried out on the order of the government, one copy of the report will also be sent to the government mandatorily. Then the government can decide whether they want to prohibit the bank from taking any further deposits. All right, so the statement 3 is also incorrect because government can also conduct the inspections. Correct answer will become 2 and 4. Okay. Again, identify the correct statements. Opening a pop-up branch for 20 days at a local mela without RBI permission is permissible. The RBI's discretion under Section 23 is limited to the financial viability alone. RBI can impose general or case specific conditions while granting branch opening permissions. Any relocation of a branch outside the same city requires prior RBI approval. So, this is regarding opening of a new place of business. So, which of the following statements are correct? So, this is given in the section 23 of the Banking Regulation Act. Without obtaining the prior permission of RBI, no banking company shall open a new place of business in India or change otherwise, that is outside the same city, town, or village, the location of an existing place of business without the prior permission of RBI. However, if they are opening a particular business not exceeding 1 month, so this is a temporary place of business. The statement 1 says it is being open for 20 days, so it is correct. Then RBI can impose general or case specific conditions while granting the branch opening permission, and any relocation of a branch outside the same city does require RBI's prior permission. So the correct answer becomes D, 1, 3 and 4. All right. So if you are opening a place of business in the same city, changing your existing place of business in the same city, that is fine. Prior permission will not be required. Or if you are opening a temporary place of business, that is also exempted. Other than that, first you need to apply for a permission. Once you get the permission, then you can proceed. All right. So the correct answer will be D. 1, 3, and 4. Statement 2 is incorrect. All right. Next. The term place of business under the section 23 includes all of the following except. So basically, the term place of business does not include the location used exclusively for board meetings, ATM kiosk without staff, office and sub office receiving the deposits. So, the section 23 of the Banking Regulation Act, subsection 5, the place of business includes any sub office, pay office, sub pay office, or any place at which the deposits are received, checks are cashed, or money is lent. So, the location exclusively used for the board meetings will be exempted. All right, so if they are opening a ATM kiosk, pay office, sub office, then the prior permission will be required, but the place of business does not include, the definition of the place of business does not include location used exclusively for the board meeting. All right, and also before granting any permission for the opening of new business, the Reserve Bank will consider the scrutiny. They should be satisfied as to the financial condition and history of the company, the general character of its management. Then they will give the permission subject to certain conditions as the central bank may think fit. And if, at the opinion of RBI, the banking company has failed to comply, then they will refuse the permission and they will give the reason in writing. Obviously, the banking company will be given a right to be heard, to explain their situation. They also have the right to appeal to the central government. Right? Yes. So if a location is for the board meetings only, to conduct the board meeting, no banking business is being carried out there, then it will not be included in the place of business. All right. Under Section 11, subsection 2 of the Banking Regulation Act, a foreign bank with a place of business in both Mumbai and Kolkata must deposit with the RBI. So now we are talking about the paid up capital and reserves. So a foreign bank, they need to deposit and keep deposited with the Reserve Bank certain amount if they have a place of business in India. Now there are different categories. If the place of business is in Mumbai or Kolkata or both or anywhere else in India, so here the question asks us that the place of business is in both Mumbai and Kolkata. So the deposit will be of rupees 20 lakhs, right? If they have a place of business anywhere else, then the amount will be 15 lakhs. If the place of business is in Bombay or Kolkata or both, then it will be 20 lakhs. Apart from this, an amount of 20% of the profit for each year in respect of the business transacted through the branches in India only. And these securities deposited can be replaced by the other unencumbered approved securities or cash. All right, so remember this point. If they have the place of business in Bombay or Kolkata, then 20 lakhs deposit will be maintained. If anywhere else, not Bombay and Kolkata, then 15 lakhs. Apart from it, 20% of the profit of each year will also be deposited. 20% of the profit that is generated from their branches or business in India. All right. Again, choose the correct statements as per the section 11 and 12. A new domestic bank with only one branch may begin operations with as little as rupees 50,000 in paid up capital and reserves under the old provisions. A bank having its entire business in one state with no office in Mumbai or Kolkata, the maximum capital requirement for them is capped at rupees 5 lakhs. The distance clause treats any office within 25 miles as within the same state, and the RBI's capital norms override section 11 for the SFBs through the customized licensing policies. A bit lengthy question. Take your time, read the statements carefully, and then answer. According to section 11 and 12 of the Banking Regulation Act, which of the following statements are correct? Yes. No, do not get confused. The correct answer is D. Yes, all the statements are correct. All the statements. So when we are talking about section 11 and 12, 11 provides for the minimum requirements as to the paid up capital and the reserves of the banking company. The banking company, if they want to commence the banking business, they have to comply with these requirements, right? We discussed about the foreign banks. If we talk about the Indian bank, again, if it has the place of business in more than one state, 5 lakh of rupees. And if any such place of business is in Bombay or Calcutta, then 10 lakhs. So more than one state, 5 lakhs. If that particular place of business is in Bombay or Calcutta, then 10 lakhs. All right, so this will be correct. Then, if it has all the places of business in one state, which is none of which is situated in Bombay or Calcutta, then 1 lakh of rupees in respect of its principal place of business, and 10,000 in respect of each of its other places in the same area where the principal place is there, and 25,000 out of that particular area, right? Hmm. And this 50,000 rupees clause means that no banking company to which this additional place of business clause is applied, they will be required to have the paid up capital and reserves exceeding an aggregate of 50,000 rupees. So first statement will also be true. All right. RBI has stipulated that under specific and different minimum capital structure or norms for the SFBs and universal banks, they will have to be separately followed. So all of these statements are correct. All right. The business situated in a state other than that in which the principal place of business is there, if it is not more than 25 miles distance from the principal place of business, it will be deemed to be situated in the same state. Otherwise, the 25,000 rupees clause will be applied. All right? Correct. Yes. Okay. According to RBI's dividend declaration guidelines, a bank may declare dividends only if its gross NPA is below 5%, the CRAR is 9% or higher for only the current year. If it has the net NPA below 7% and CRAR is more than or equal to 9% for 3 years, the net profit exists and CRAR is more than 9% for the preceding 2 years and the current year. Again, when we are talking about the shareholding in the banking companies or the commission, brokerage, discount, payment of dividend, all of these points are very important. The institute can ask you direct question. All right. So the banking companies will be eligible to declare dividends only when they comply with the minimum prudential requirements. First, the proposed dividend should be made or it should be paid only out of the current year's net profit. This is the first provision. Second, the bank should have CRAR of at least 9% minimum. More than that, even better. And the net NPA should be less than 7%. If these two things are not followed, then the banks cannot declare the dividend. Also, the CRAR for the preceding two completed years and the accounting year for which it proposes. Alright, so the correct answer will be D. Net profit exists and the CRAR minimum 9% for the preceding 2 years as well as the current accounting year. There's also an exception to this, if you remember. If, let's say, the bank does not meet the 9% criteria, that is more than 9%, still they have at least 9% for the current accounting year for which it is proposing to declare the dividend, and the net NPA for that particular year is less than 5%. Then also they will be allowed to declare dividends. All right. So if the preceding 2 years the CRAR is not met, current year it is there, and the net NPA is less than 5%, then also they will be allowed. So the correct answer becomes D. Both the situations I have included here. Okay. Again, this is a scenario based question. The government of India is considering issuing directions to RBI regarding emergency liquidity provisions for the struggling NBFCs. Under the section 7 subsection 1 of the RBI Act, which of the following conditions must be met for such directions to be legally valid? The directions must be issued after prior approval from the parliament. The government can issue directions unilaterally without consulting any authority. The directions must be approved by the Central Board of RBI before implementation. The government must consult the governor of the RBI before issuing such directions. What will be the correct answer here? Hmm. Yes, we have already seen the government must consult the governor of RBI before issuing such directions. Then, whatever directions are prepared, they will be sent to the parliament, they will be approved. These are the secondary things. But they must consult the governor. They cannot issue it before the prior approval of parliament, not unilaterally, and not without the approval. All right? No, it will be D. Right? Approval of the central board before implementation, that is not always true, but the government must consult the governor of RBI before issuing such directions. Dividend question. You want me to go back to it? This one? What do you want to ask? Okay, you were answering C or D for the dividend question. Okay. No, it is not for 3 years. C will not be true because the CRAR is to be applied for the preceding 2 years, and the net NPA should be below 7% for the particular year, for that year in which the bank is declaring the dividend. That is why D is correct, not C. All right. Now answer this question. Section 13 of the Banking Regulation Act caps the commission and related charges on the share issuance act. So, under the Section 13, Banking Regulation Act imposes a ceiling on the commission, brokerage, discount, or remuneration on the sale of shares of the banking companies. So, how should the payment on this account will be done? 2% of the face value of the shares, 2.5% of the paid up value of the shares, 2.5% of issue price of the shares, or 5% of the net profit of the previous year. How should the payment be done? All right. Prior to the amendment that was made in 2013, the payment of the dividend was linked to the paid up value of the shares. The paid up value of shares. But now it is restricted to 2.5% of the issue price of the shares. Very important question. It has been asked in the previous exam cycles as well. All right. So earlier the norm was 2.5% of the paid up value of shares, but now it is 2.5% of the issue price of shares. Please remember this point. All right, do not get confused. 2.5% of the issue price of the shares. This is the norm. So the payments on this account in any form, if they are paying the commission, brokerage, discount, anything, remuneration on the sale of shares, this should not exceed 2.5% of the price at which the said shares are issued. So issue price. 2.5% of the issue price. All right. A banking company's director has served without interruption for 9 years. According to Section 10A, this is valid for directors nominated by RBI only, allowed only with the shareholders' approval, prohibited as the maximum tenure is 8 years continuously, or it is permissible for the chairman only. So if the director is holding their position for 9 years, then what is the situation? If we are talking about the period of office, the directors of the banking company shall not hold office for more than 8 years continuously. All right, so in this situation, this person is holding their office for more than 8 years, so it will be prohibited because the maximum tenure is 8 years. They can be reappointed right after a particular break, but continuously maximum 8 years is allowed. This provision is also not applicable to the chairman or a whole time director. When, let's say, the chairman or the whole time director is removed from the office, they also cease to be the director and they cannot be eligible for further appointment for a period of 4 years. This provision is also there. All right. So this situation will be prohibited because the maximum tenure is 8 years continuously. Okay, next. Who is not disqualified from being appointed as a director of a banking company, a proprietor of an SSI unit, a managing agent of a steel trading firm, an employee of a transport firm, or a 12% shareholder in a large, fast moving consumer goods company. So there are certain restrictions on employment, right? A person who has been adjudicated insolvent, a person who has been convicted by a criminal court, a person whose remuneration is by the way of commission or share in the profit of that company, and a person whose remuneration is in excessive in the opinion of RBI. All right. So, persons who are engaged in any other business or vocation, or whose term or office of a person maintaining the company for a period exceeding 5 years, they will also fall in the prohibited category. So, a proprietor of a SSI unit is prohibited. All right. Yes. So, this is the restriction on employment of any person on the board of directors of a banking company. All right. This is clear. Okay. Contravention of the RBI's removal order under section 36AA. Let's say RBI has given the order to a banking company that this person should be removed from the board of directors or the managerial personnel, but the bank is not complying with the direction. So, what will be the penalty or what will be the action? Cancellation of all the directorships held by the person, fine of rupees 250 per day for the continued contravention, imprisonment for up to 1 year, disqualification from any company board. Right. So, if it is a continued offense, meaning that the contravention is continuing for more than 1 day, then a fine of rupees 250 per day for the continued contravention. Whenever RBI is passing such order, they have to do it in writing, they have to give the reasons in writing. They will also give an opportunity to the person against whom the proposed order is made. Where let's say it is urgent, then RBI can, without giving opportunity of representation, they can directly remove the person, right? And that person shall not be entitled to any compensation for the loss of office. Appeal, however, can be made. Appeal will be made to the central government, and the appellate decision will be final. It cannot be challenged in any court after that. All right, so a contravention of the RBI's removal, that is, the banking company is not complying with the order, will attract a fine. Okay. So, a well established foreign bank, Global Trust Bank, wishes to open a wholly owned subsidiary in India. According to RBI's licensing requirement, which of the following conditions must be satisfied before it can operate in India? The Global Trust Bank must obtain approval from RBI alone, and home country approval is not mandatory. RBI will only consider the financial soundness while evaluating the application. The home country regulator must approve the setup of the wholly owned subsidiary alongside RBI scrutiny. The foreign banks do not need licensing if they have international operations in other major economies. So, this is the licensing requirement. So, foreign banks, if they want to set up a branch or a wholly owned subsidiary, they will have to apply for a license with RBI. RBI will take into consideration many things. They will see the fit and proper criteria. RBI will check the economic relations between India and that particular country. Apart from it, does it have a registration incorporation under the Companies Act of that particular country or not? All of these things will be checked. So the correct answer will become C, right? So the home country regulator must approve the setup alongside RBI scrutiny. So both the things are important. RBI scrutiny will also be done, and RBI will also see that the regulator of the home country has also approved the setting up of the wholly owned subsidiary in India. All right, okay. Choose the statements that are true. Nomination ensures deposit security until estate succession is sorted. Guardian appointed for minor nominee can use funds without restriction. A depositor can cancel the nomination multiple times during their lifetime, and a bank must obtain succession certificate even if nominee is recorded. So now we are talking about the regulation of nomination or deposits. So which statements will be true regarding the nomination? So a depositor can nominate one person who is entitled to the rights of the original depositor on the death of the sole depositor, right? And it can be varied or cancelled at any time. This statement, when we are talking about that the nomination is made in respect of a minor, can the guardian use the funds as per their wish without any restriction? This will become incorrect. All right, so the correct answer will become 1 and 3. 1 and 3. Okay, so the depositor is empowered to make a regulation regarding the any person as the nominee, and on the death of the original depositor, the funds amount will be returned in the event of death under the nomination. It can be varied, it can be cancelled. Where the nominee is a minor, appointment of a person who is the guardian to receive the deposit, this is also there, right? Statement 4 says that the banks must obtain the succession certificate. That is not true. Banks will try that no undue difficulties given to the nominees or the successors. So if the nomination is clearly made, then this succession certificate is not required. All right. Okay. Which of the following is prohibited under Section 20 of the Banking Regulation Act? Granting loans against bullion, granting loans to government departments, granting overdrafts to the scheduled banks, or granting loans to the bank's own shares as security. So these are the regulation on loans. So which of the following statements are correct? Hmm, right. Here the correct answer is D. Restrictions on loans and advances. Prohibition applies to firms in which any director is interested as a partner, manager, employee, or guarantor. Any company in which the director has a substantial interest. If the director of the banking company is a partner or guarantor of an individual, then also the loan cannot be given. Also, the loans and advances cannot be granted against the security of its own shares. Right? So D will be correct. Granting loans on the bank's own shares as security is prohibited under section 20. Okay. Now choose the correct statements here. Loans to a firm where the director is only a sleeping partner are permitted under RBI's discretion. Any remission in contravention of the section 20A is void and without effect. Banks may remit the director related debts without permission if it is backed by collateral. Section 20 prohibits any form of commitment even on behalf of a director. Same content or same information, use it here as well. The statement, second statement. Second statement says any remission made in contravention of section 20 is void and will have no effect. This is a very strict rule. If under section 20 it is clearly stated that loans cannot be given to any director of the same banking company or any company in which the director has a substantial interest, if let's say the bank contravenes and gives a loan, it will become void without effect. So statement 2 will be correct. And section 20 also prohibits any form of commitment even on behalf of the director, which means that if they're acting as a guarantor, if they're indemnifying, then also it is prohibited. So the correct answer will become 2 and 4. All right, bank cannot remit the director if the loan is with a collateral, if it is a secured loan, or the loans to a firm where the director is only a sleeping partner is not permitted. So the correct answer becomes C, 2 and 4 only. Okay. Now this question you need to differentiate between the base rate and the MCLR and the external benchmarks. So the base rate included average cost of funds and excluded the repo linked elements. MCLR brought in higher borrower specific transparency than BPLR or base rate. Banks could revise their base rate benchmarks even after December 2010, and the MCLR allows banks to determine different benchmarks for the different loan tenors. So this is regarding the regulation of interest rates. So in the beginning, the rates of interest on deposits were not regulated by RBI, but it led to exorbitant rates by some banks or discriminatory rates by other banks. Then RBI started regulating these rates. After that, RBI, after much consideration, the deregulation of interest rate on deposits was followed. So now interest rate on the deposits are deregulated. Banks, they can set their own rates. Earlier, what was followed? The BPLR system was there, but it was short of the original objective of creating transparency. Then the base rate replaced the BPLR. Then the base rate was replaced by the MCLR, the marginal cost of fund based lending rate, and now the external benchmark is being used. Right. So what is the difference between MCLR and base rate? MCLR we know is determined by the current cost of funds. Base rate is governed by the average cost of fund. MCLR also considers the loan tenor, but base rate considers the minimum rate of return or profit margin. MCLR also considers the deposit rate and repo rate, which is not there in the base rate. Right, so repo rate does not form part of the base rate. These are the differences. So the correct answer will be B, 1, 2 and 4. Not D, but the correct answer will be B. Third statement is not true. When we are talking about the revision of their base rates, when can be done? It cannot be done after this time period. All right. So, in order to give banks time to stabilize the system of base rate calculation, banks were permitted to change the benchmark and methodology anytime during the initial 6 month period, but before end of December 2010, not beyond that. That is why the third statement is incorrect. All right? Okay. Next, the interest rate under the external benchmark must be reset annually at every 6 months based on each bank's discretion or at least once in every 3 months. So, the Reserve Bank of India in the financial year 2018-19, they stated that all new floating rate personal or the retail loans, even the loans to the micro and small enterprises, they will be linked to the external benchmark. So it was announced in 2019-20 that external benchmarks will be used. And these external benchmarks have also to be reset. So what is this time period when the external benchmark should be reset? It will be done at least in every 3 months. All right? At least in every 3 months. When we are talking about the external benchmark, then we can use the RBI policy repo rate. We can also use the Government of India 3 months Treasury bill yield published by the FBIL or any other benchmark published by the FBIL, right? However, a uniform external benchmark within the loan category should be adopted. All of these points are there. Yes, a uniform benchmark under one loan category will be adopted. Banks, they cannot offer different benchmarks under the same loan category. Adoption of multiple benchmarks is not allowed. All right. So the interest rate under the external benchmark shall be reset at least once in 3 months, and the other components of the spread, the operating cost, should be altered once in 3 years. These are the 2 points. Okay. A banking company, Festive Finance, wants to set up a temporary banking counter at a large trade exhibition in Kolkata for 1 month. Which of the following actions should be legally permissible? Festive Finance can open the temporary counter without RBI approval since it is a part of the same city. The Festive Finance must obtain full RBI licensing before setting up the temporary counter. The Festival Finance can set up the counter only if it restricts operation to check cashing and deposits. RBI does not allow the temporary banking counters under any circumstances. Very simple, we have already discussed. If the banking company wants to open a new place of business, they require RBI's permission. But if they're setting up a temporary counter for less than 1 month, then they can do so without RBI approval, right? So without RBI approval, they're allowed to set up this temporary counter. Okay. Hmm. Identify the correct statements. RBI may require daily asset liability returns in addition to alternate Friday filings. Returns under Section 25 are annual and require the RBI clearance before filing. Unclaimed deposits under the DEAF must be refunded to the claimants by the bank even after 10 years. And RBI may call for half yearly advance classification reports from the banks. So this is regarding the returns, right? The annual accounts and balance sheet. All the banks whose shares are listed with the stock exchange, they're required to publish their unaudited quarterly results. They're also required to prepare the balance sheet and profit and loss account at the end of each calendar year. I hope you remember all of these points. So, which of these statements are correct? So, RBI may require daily asset liability results in addition to alternate Friday filings. This is true. If in one particular circumstance RBI gives this direction, it will have to be followed. The returns under section 25 are annual and require RBI clearance before filing. Is this statement correct? And if not, then what will be the correct point? Hmm. So this is regarding the assets in India, the quarterly position of assets. So section 25, the assets in India for every banking company at the close of business on the last Friday of every quarter is required, right? And it does not require the RBI clearance. That is why this statement will be incorrect. Rest all 1, 3 and 4 are correct. Unclaimed deposits under the DEAF must be returned to the claimants even after 10 years. Let's say they're coming to the bank giving satisfactory reasons, it will be returned. RBI can also call for half yearly advance classification reports from the banks. So, all of these points that are given in the question, remember these points. Multiple selection questions or direct questions, true or false questions, anything can be asked by the institute. All right. The RBI's annual financial inspections are now primarily conducted under which framework? The Statutory Inspection Norms 2010, the Supervisory Review and Evaluation Process, the Risk Based Supervision using Spark, or Credit Surveillance Assessment Plan. The annual financial inspection under the Section 35 of the Banking Regulation Act is yes, it is nowadays. It mainly assesses the different types of risks. So it is a risk-based assessment using Spark. What is the full form of Spark? The Supervisory Program on Assessment of Risk and Capital. And then they issue the risk assessment reports. Other types of inspections from time to time will also be conducted. No, not SREP. Spark will be correct. The Supervisory Program on Assessment of Risk and Capital. AFI is based on the Spark. All right, go through these points, download the PDF, and you can go through these notes as well. Okay. RBI can order a special audit for any specific transaction or period it deems necessary. Inspection teams may demand submission of internal memos or correspondence. RBI may inspect any bank branch even in the absence of a risk trigger. Banks may refuse to comply with inspections if they concern the third party accounts. So, regarding the special audit or inspections, the functions, powers, duties of the auditors. liabilities, penalties, these are defined in the Companies Act. But RBI is going to authorize the auditors to conduct the audit, particularly if it is a special audit. RBI is empowered to conduct or order a special audit and it has to be complied. It can be because of any transaction or a class of transaction. By the same order, they can appoint a duly qualified auditor, and the expense of the special audit has to be borne by the banking company. All right. So RBI can order a special audit for any transactions, true. The inspection teams may demand the submission. They can go to the bank, they can ask for any information, any document, and RBI can also inspect any bank branch even in the absence of a risk trigger. However, when this notice or order is given by RBI, banks cannot refuse to comply with the inspections. So 1, 2, and 3. Banks will have to follow the orders and conduct the inspection or the special audit. All right. So 1, 2, and 3 are correct and 4 is incorrect. Okay. Identify the correct statements. A shareholder who dissents to the amalgamation has a right to exit with compensation if RBI sanctions the scheme. RBI must sanction an amalgamation even if the shareholders dissent, provided two-thirds support is obtained. Moratorium under Section 45 restricts the payments to the depositors unless the government directs otherwise. RBI has no power to recommend a moratorium without the prior consultation with the High Court. So, which of the following statements are correct? The order of amalgamation of the banks can be given by RBI, can be given by the government. Voluntary amalgamation can also be there. The scheme will be prepared by RBI. So, which of the following statements are correct regarding the amalgamation? So, voluntary amalgamation when the banking company is amalgamated with another banking company. Scheme will be prepared. The terms of such an amalgamation will be placed before the shareholders of the two companies separately. And it has to be approved by a resolution passed by the majority. So, majority means two-thirds of the shareholders of each company. They will have to give their approval. And if a shareholder who votes against such scheme, they have the right, they can claim the value of his shares and they can exit from the amalgamated company. All right, so this statement 1 is correct. The RBI must sanction an amalgamation even if the shareholders dissent. This is not true. If the shareholders are not agreeing, they will be given the right that they can exit. Okay. Moratorium restricts under Section 45 the payments to depositors unless the government directs otherwise. So when we are talking about the moratorium, RBI can apply to the central government for an order of moratorium if it is there's a good reason to do so. In this particular period, for a fixed period, there will be a stay on the proceedings. However, this moratorium will not exceed 6 months. All right. So the moratorium will restrict payment to depositors unless the government directs otherwise. So this is also true. And RBI has no power to recommend no. RBI has the power. If RBI wants to recommend a moratorium, they will do so. It is not necessary that they consult first the High Court. All right, so the correct answer will be A, 1 and 3. So RBI is authorized under Section 45 to apply to the central government for an order of moratorium. Then the central government can pass an order staying the commencement, continuation of any action, whatever terms and conditions they deem fit. Okay. Winding up of a bank must be ordered by the High Court when? When will the High Court give an order of the winding up of a bank? After the RBI's inspection, the report recommends structural overhaul. The bank reports CRAR below 3%. Bank is unable to pay its debts or RBI files for winding up. Statutory auditor fails to submit accounts within 3 months. So, in which of these following conditions it is necessary that the High Court must order the winding up of a bank? So, two situations are there: when the bank is unable to pay its debts or RBI files for the winding up. In these two situations, the High Court shall order the winding up of the banking company. All right? The central government, if they are of the opinion that the affairs of the banks are being conducted to the detriment of the interest of the depositors, again the banking company will be given an opportunity to be heard to make a representation to show their cause. All right. Now read these statements and select the true ones. A bank under moratorium may be wound up if its management harms the depositor interest. RBI has the discretion to not apply for winding up even when insolvency is clear. The central government can override RBI's refusal to wind up by approaching the Supreme Court. The High Court must consider the interest of the depositors and the banking system in the moratorium orders. So, regarding the winding up, what powers are there with RBI? What powers are there with the High Court or the central government? So, a bank who is under moratorium means a stay on proceedings is there. If the bank is conducting any activity which is harming the depositor's interest, it will be wound up. This is true. RBI has the discretion to not apply for winding up even when the insolvency is clear. No. If the banking company is clearly becoming insolvent, they're unable to pay the debts, mandatorily the winding up order has to be given. So the statement 2 is incorrect. Then the third statement, the central government can override RBI's refusal to wind up by approaching the Supreme Court. Again, no. RBI's decision here will be considered final, and the High Court must consider the interest of the depositors and the banking system in the moratorium orders. So the correct answer will be B, 1 and 4. All right, so the suspension of business and winding up a banking company that is, let's say, temporarily unable to meet the obligations, there the moratorium will be given, but subject to the terms and conditions imposed by the High Court, and it shall not exceed 6 months. If, let's say, the banking company, it is clear that they are unable to pay the debts, then the insolvency will be final. Okay, all right. What conditions? Okay, the conditions maybe, let's say, when the compromise or the arrangement cannot be worked out, or the returns or the statements, information which is given by the bank, they clearly show that they cannot pay its debt, or the continuance of the banking company will be against the interest of the depositors, then it will be final to order the winding up. And when the Reserve Bank makes an application for winding up, the court is bound to allow the application. It cannot be questioned. All right? Okay. Now answer this question. Only shareholders other than RBI can elect certain directors on the SBI's board. An official of SBI can be appointed as its statutory auditor subject to RBI approval. SBI can acquire another bank's business only with central government sanction or direction. The list of SBI shareholders must be submitted to RBI within 1 month of the end of the financial year. So, regarding the working of SBI, which statements are correct? So, SBI, as we have already seen, is established under the State Bank of India Act of 1955. Management, the central place of office is in Mumbai. Local offices are there in Kolkata, Chennai, any other place decided by the central government. If we are talking about the composition of the board, there will be a chairman, not more than four managing directors appointed by the central government, and other directors. Other directors will be workmen, officers nominated by the central government in consultation with RBI. Business of State Bank, basically they're going to act as the agent of Reserve Bank. If we are talking about the audit, then they are required to close its books and balance each year as on 31st March, and within 3 months of the closing date, they will have to furnish to the central government and RBI its balance sheet and profit and loss account. All right. So, what will be the correct answer? Only shareholders other than RBI can elect directors on the SBI's board. This is true. An officer of the SBI can be appointed as its statutory auditor subject to RBI approval. This will not be correct. And the third statement is true. All right. So the correct answer will be A, 1 and 3. 1 and 3. All right. Regarding the functioning of SBI. Okay. The shareholding structure of a typical RRB, a regional rural bank, is as follows. So a sponsor bank will have 51% shareholding, RBI 24%, state government 25, or sponsor bank 40%, central government 40%, state government 20%. So what will be the shareholding of the RRB? Quickly answer this question. RRBs are also public sector institutions. These are regionally based, rurally oriented, engaged in commercial banking, set up under the RRB Act of 1976, right? The central government is going to establish the RRB, and there should be a sponsor bank by which the RRB is sponsored. So, if we are talking about the shareholding, the sponsor bank is going to hold 35%, the central government will be holding 50%, and the remaining 15% will be held by the state government. So, this will be the shareholding criteria. So, the sponsor bank 35% shareholding, central government will have 50%, and state government will have 15%. Other than this, if we are talking about the management of the affairs, it rests with the board of directors, right? Board of directors, the directors will be appointed in consultation with the sponsor bank and with previous approval of the central government. The chairman appointed by the sponsor bank, and chairman holds on a whole time basis the position. All right. Okay. Next, the cooperative banks cannot grant unsecured loans to firms in which any director is a partner or guarantor. The loans backed by the trust receipts may be exempt from unsecured lending restrictions. The RBI can ban further unsecured lending even if the earlier loans are complied with disclosure rules. RBI cannot intervene in the repayment terms after return submission. So regarding the cooperative banks, which of the following statements are correct? Basic things we already know. A cooperative bank under the, let's say, if it is operating in more than one state, so the Central Act, the Multi-State Cooperative Societies Act will apply. If it is operating in only one state, then the state law will govern the business, right? The Section 56 of the Banking Regulation Act applies to the cooperative society. So, which statements are correct? Can the cooperative bank grant loans, unsecured loans, to the firms in which the director is a partner? No. So, the first statement is correct. Then the loans backed by the trust receipt may be exempt from unsecured lending restrictions. This is also true. And the RBI can ban further unsecured lending. This is also true. But the fourth statement that RBI cannot intervene in the repayment terms after the return submission, this is incorrect. All right, so all of these things are given in the section 20 of the Banking Regulation Act, which is applicable to the cooperative societies. So, loans and advances. What are the prohibitions? A cooperative bank cannot grant loans and advances on security of its own shares, or they cannot give unsecured loans to any of its directors or to the private firms or companies. However, the unsecured loans or advances to any company in which the chairman is also engaged, that is also prohibited. All right, so 1, 2, and 3. These are the restrictions on the cooperative banks. All right. Which of the following statements about computing the liquid assets is incorrect? The fixed deposits with NBFCs qualify as the liquid assets. The net balances in the current accounts are considered. Scheduled private cooperative banks can include the excess RBI balances over Section 42, and the state cooperative banks may include balances with RBI beyond the mandated cash reserve ratio. So, when we are talking about the liquid assets, then which of the following will be true about the liquid assets of the cooperative banks? We know that the cooperative banks have to maintain liquid assets as per the section 24 of the Banking Regulation Act. What all do we include in the liquid asset? So any balances maintained by the cooperative bank in the current account with RBI, or in case of the central cooperative banks, if they are maintaining the balances with the state cooperative, these will also be included. Similarly, the scheduled primary cooperative banks in excess of the RBI balances, however, it will not include the fixed deposits with NBFCs. All right, so the fixed deposits with NBFCs do not qualify as the liquid assets of the cooperative banks because they are fixed. Liquid assets are those which can be easily converted. All right, even cash or balances maintained in India by the non-scheduled banks, the balance maintained by a scheduled private cooperative bank, state cooperative banks, all of these will be included. All right, so the correct answer will be A. Then, which of the following entities is ineligible to apply for a payment bank license? A real sector cooperative owned and controlled by the residents, a public sector telecom provider, a foreign fintech holding 40% stake in a prepaid payment instrument, or a resident NBFC with 5 plus years of operational track record. So we are talking about the promoters of a payment bank. Who are the promoters? existing non-bank PPI issuers, NBFCs, corporate business correspondents, mobile telephone companies, public sector entities, all of these are allowed. But foreign fintech firms that are holding 40% stake in the prepaid payment instrument, these are ineligible to apply for a payment bank license. All right. So all the promoters, the eligible promoters who can set up a payment instrument, these are given. Let us do a few more questions and then we will end the session. Okay, as per RBI's revised guidelines dated 8th April 2021, the end of day customer balance limit per individual in a payments bank was raised to. So these revised guidelines have increased the end of day customer balance limit. So what is the increased limit? Whether it is 1 lakh rupees, 1.5 lakh rupees, 2.5 lakh rupees or 2 lakhs. So initially the payment banks were restricted to holding a maximum balance of rupees 1 lakh per individual customer, right? But this has been increased and it has increased to rupees 2 lakhs only. All right, so this revision has increased it to rupees 2 lakhs on 8th April 2021. Other than that, payment banks can issue ATM or debit cards but cannot issue credit cards. They can also allow payments and remittance, act as banking correspondent of another bank, distribution of the non-risk sharing financial products. All of these activities are allowed to be conducted. Okay, Sunrise Bank Limited is issuing new shares at rupees 120 per share. It plans to pay a brokerage of rupees 3.60 per share to its lead underwriter. Which of the following is true under Section 13 of the Banking Regulation Act? So they have issued new shares at rupees 120 per share. And the brokerage that they are planning to pay is rupees 3.60. So, does the proposed brokerage violate RBI's limit on commission and it must be revised? Or there is no ceiling on brokerage? Since the brokerage is only 3%, it is acceptable. A banking company cannot pay any brokerage. So, we have already discussed this. The brokerage that the company can pay is 2.5% of the issue price. The issue price is 120 rupees per share. 3.60 makes it 3%. So the proposed brokerage violates RBI's limit and it must be revised. Maximum 2.5% can be paid. 2.5% of the issue price. All right? Okay. Next, as per Section 45 of the RBI Act, no NBFC can carry on a business without the net profit for 3 consecutive years, without the registration with SEBI and RBI, without a certificate of registration from RBI and the required net owned funds, without a dual regulation clearance from SEBI as well as NHB. So, when we were studying about the NBFC's license, we mentioned that there are certain exemptions. Those NBFCs which are already registered under the particular apex society or they are governed by a particular act, they need not apply for a registration or license with RBI again. Right? So the correct answer will become C, that they cannot carry on the banking business without certificate of registration from RBI and the required net owned fund. Right? They should have the net owned fund of 25 lakh rupees or in any other case not exceeding 100 crore rupees as specified by RBI. And also they have to obtain a certificate of registration. and the list of those NBFCs that do not require a registration from RBI. If you remember, can someone, correct, right? So Nidhi companies under the Companies Act, chit companies under the Chit Funds Act, housing finance companies under NHB, venture capital fund under SEBI, insurance company under IRDAI, these are exempted. All right. Which of the following are true with regard to the exemptions? Already we have answered this question. So which of the following are exempted from the registration? Chit fund companies are exempted from registration under the RBI Act. Already discussed. Yes, they are. Insurance companies registered with IRDAI still require a CRR account? No. The registration exemption extends to the Nidhi companies as well. Mutual benefit companies and stock exchanges are entirely exempt. Again, no. Mutual fund companies, if they are registered, the merchant banking companies, venture capital companies, if they are registered with SEBI. So without any clause, that is not true. All right. So this is the list of those entities, those NBFCs that do not require a separate registration from RBI. Okay. Which of the following NBFCs would always fall in the upper layer? So we have the four layers: base layer, middle layer, top layer, and upper layer of the NBFCs. So which of the following will always fall in the upper layer? NBFCs that have a negative net worth, top 10 NBFCs in terms of the asset size, all the NBFCs which are regulated by RBI, NBFCs that do not raise public funds. So in the upper layer would always comprise of those NBFCs which are specifically identified by the RBI as warranting enhanced regulatory requirement. So the top 10 eligible NBFCs, irrespective of in which type they are, in which category they are, in terms of their asset size, will be in the upper layer. And if they are taking even more risk, then they will be shifted from the upper layer to the top layer. All right. So you need to remember all the different categories of NBFCs and in which layer they will be placed. Let us do one more question. This is the last question for today. After acquiring Capital Line Bank, the central government decides not to retain the undertakings directly, but to vest it in Progressive Bank Limited, a public sector entity. What will be the status of the assets and the liabilities of the Capital Line Bank? The assets and liabilities remain with the central government. Only liabilities vest in the transferee bank. Assets remain with the government. Both assets and liabilities vest in the Progressive Bank Limited. The transferee bank must renegotiate all the existing liabilities. So, if the central government is acquiring the public sector bank, they can decide to hold the asset or liabilities with themselves or they can transfer it to another bank. And both the liabilities and the assets, they will be transferred. So the correct answer will not be A, it will be C. All right, it will be C. Because the government is deciding not to retain the undertaking but vest it to the transferee bank. So both the assets and the liabilities will vest in the Progressive Bank Limited. All right, so although we had about 10-15 questions more, but let us stop here. You will get the PDF. I will upload the PDF with the remaining questions also that you can use for your revision. I have included the answers and the explanation in the PDF. So download the PDF, go through the questions, and now after 5 minutes, we will meet in the capsule batch and we are going to start the module B. All right. So, okay, let us meet in the capsule batch. And tomorrow at 7 p.m., we are going to discuss the questions from Module B. That is all for today. Thank you so much. Download the PDF, go through the notes, and I will see you tomorrow. All right.